All right, I'm all set now. Okay, welcome back. We had a gap of a week. I wasn't here last week for all the good reasons. I think that was a weekend spent well. Hope you didn't miss me. You had, some other great stuff to do. Anything to share? Any special things? What did I miss last week? For those who don't know, I was at a tour conducted by, this tasty trade team, bad trader tour. It was good. I get to meet a few of you. So it was a chance meeting. I don't know I met Jay in person. Um, I met Ame in person. So it was good. It was a good session, good learning, and good to meet some fellow investors / traders in person. And yeah, what else? Anything new you guys have to share before we jump into session? Any excitement on the market? Yeah. I know August hasn't been that great so far, but who cares? It's just a month. This week was tough. Uh, when I say tough, S&P is down what 5% or 4% from its recent highs, but still, what SPY is where? Where is it? SPY trading. SPY is trading. It's up 14.62% for the year. Right? Still, if you had gone on holiday by end of 2022, you came back today and you're looking at your portfolio or overall market and see SPY's trading at 14.62% higher. Oh, that's a great return, right? It's more than the average return of the market. What else to? It's time to celebrate, I would say. But we always compare with the relative performance. Oh, it was 20% a week ago. So if it is only 14.5%, it's bad. No, I don't think it's bad. And it would say market is going down. China unemployment inflation brought few sectors down. Yeah, we will talk about China. There are a lot of news coming out of China, good, bad, ugly, depending on your viewpoint. But I do want to talk about China as well today. Right. So waiting for NVIDIA on Wednesday, 2023. I think everyone is waiting for NVIDIA. And it was, was it this week or the last week? I think all the street analysts, they've upgraded their targets for NVIDIA. And it looks like so childish to me. They're just chasing the price. I mean, and I don't want to berate them, but it's their job. If the NVIDIA is trading at whatever 432, 430, and if they're still holding, how do they justify to their clients on if their price target was $200? How do they justify it? And everyone wants to make sure that before they close the year or close the quarter, they need to show those profits and trying to pile up in NVIDIA. We will go through some of those 13Fs. And I was looking at 13Fs, these big institution hedge funds, many of them now piling up on NVIDIA. So that makes me more scary on NVIDIA. As you guys know, I had openly shared why my whole thesis of why I'm bullish on NVIDIA, but I sold half of my holdings on NVIDIA, right? And I don't have any remorse on selling half of it. NVIDIA is back pretty close to where I sold it, but that's still fine. It could still double from here, and I won't mind it. I still hold half of my position. But this kind of give me a like Cisco moment of 2000, when everyone is piling up and thinking that NVIDIA will continue to be able to capture the whole market share for the next 10, 15 years. And all VC money is going into AI, any new companies that are coming. I know, just add a name AI to your company, and you increase your chances of getting funded by 90%. So even I'm seeing some of my ex-employers, and we did not have anything to do with AI because I know that product. And now I'm seeing some posts around how, using the word AI. So to me, it's a big hype, but hype can continue for longer. Can you address recession as 2 years ago belated? What would happen? I call 2008 implosion. I don't know. I mean, it's so funny that by the end of July, most analysts, even most economists, and okay, let's start the year. When we started the year, 70% of the economists were saying that there's going to be a recession, we're going to have a hard landing. Go back and look at the surveys of all CEOs. Everyone was preparing for tsunami, as Mr. Jamie Dimon would love to say, right? Economic tsunami. What happened? Market continued to go up, numbers started to come better, and by the time July came in, the hard landing was completely out of question. Whether we're going to have a soft landing or whether we may have no landing itself was being discussed, right? So now everyone is saying, probably no recession in sight. And we're talking about, PhDs, economists, right? They can't get it right. If they can't predict about economy or recession, I mean, who am I to make any predictions? So Sam, to answer your questions, I don't know whether recession will come or not. If everyone has already been preparing for a recession and have adjusted their operations accordingly, maybe we'll not see the recession. But I have no idea. So, and I don't want to prepare my portfolio based on whether recession will come or not. Yield curve was inverted, and looking at the yield curve inversion, generally it's between 12 to 18 months. We see the recession start to trickle in. But let's also talk about the fact that now there are a lot more forces in the market than what used to be in, let's say, history, from where we're picking all the data. Fed has been a lot more active in the markets or in providing liquidity to the companies. So it's anybody's guess. But generally, when the yield curve start to move back into steepening from inversion, is when we see recession start to come in. And right now we are seeing that the yield curve is now started to steepen. I think I have a chart over there. But will recession be hard? Will recession be soft? I don't know. And neither I think any of talking heads know. It's anybody's guess. I say Palo Alto Network surprised all reporting on Friday. Yeah, that was strange. And now all the reporters and the analysts have to work on Friday evening. They were definitely not happy about it. And many of them first thought that probably it was a mistake and Palo Alto will correct it. But no, they did report it on end of Friday, and the results were good. And there were some analysts, they were also thinking maybe the results are not that good, and that is why they're reporting on Friday, because by the time Monday comes in, it's like 2 days gap to see the reaction and all that. But the result was really good. Stock was, I think it's also up 5-7%, whatever. But yeah, that was a little surprising that they reported on Friday. I mean, only company that I know which report their results on weekend is Berkshire Hathaway, because they anyway don't care about markets. They don't care about what analysts have to think about them, right? So, what else? Let me make sure I can share my screen. Yeah, we've been talking about it. All right. Well, let's continue on the questions, then we'll get through the doc. Because the PE of NVIDIA is way too high. I mean, not just look. So if you look at a PE, that's like 200 plus. If NVIDIA PE we're looking at, that's 200, 225. But I would rather look at forward PE than just a PE, because NVIDIA has now told, certainly told market that, hey, our future is going to be very different than what our past was. They had nothing related to AI in the past, but in the future is going to be very different. So look at I would rather look at my forward PE, which is still pretty high, right? 37.27. And if you go through the standard valuation method, I'm not saying that applies to NVIDIA, because NVIDIA is still behaving and acting like a growth company. But the current pricing assumes that NVIDIA has captured all the AI market, which is, let's say, at extreme heights, at a very aggressive, it's like $300 billion AI market. And I don't think that will be the case. That may be the case right now, that NVIDIA has about 80%, 90% of the chips market for AI. But if this AI continues to be so strong, competition will come in, right? And that is why short term, who knows, the stock could go anywhere. And I might be wrong. NVIDIA could go to 600, and then, I'll say, see, I still hold half of my portfolio. I still hold some NVIDIA shares, 50% of it. If it goes down, I can say, see, I actually sold half of it. So kind of have your cake and eat it too. But I feel it is a lot more driven by narrative than the real results that we have seen. We'll figure it out. Maybe this quarter is going to be a blowout quarter for NVIDIA. Probably will be, because we're looking at a lot of orders coming from Middle East, a lot of orders from China. But the bigger question is, again, NVIDIA designs the chips. They don't make it. How about, will the supply chain be enough to service those chips for NVIDIA to recognize the revenue? Right? All those could just be sitting in a bookings. So will TSMC be able to make all the chips that NVIDIA needs? Looking at the TSMC stock, that doesn't look to be the case. Right? TSMC, so NVIDIA is about 202%. Looking at TSM, it's about 23% for the year. How will NVIDIA be, anyone, those who are looking to buy the, let's say, chips, will get AI chips if TSMC can't make it? NVIDIA doesn't manufacture their chips. They get it from TSMC. So anyway, that's my thesis. I think everyone is, no one wants to look fool, especially when the professional money managers, and they have not been in NVIDIA. Look at and look at the last year's, 13F. You may not find NVIDIA in hedge funds. That are like one of the top holdings for hedge funds. But now, how do you explain to your clients who would see, their neighbor who had piled up on NVIDIA is up more than 200%, or their portfolio is up 100%, and I give money to you, Mr. Professional Money Manager, and I am up, what, 14%? Because that's why S&P is up 14% only. And anyway, 80% of the professional money manager, they don't even meet the index performance. So and if you are, not one of those 20 lucky ones, so on an average, you will be underperforming the index. How do you even justify someone, if you're not holding NVIDIA in your portfolio, to say, guys, give me the money? So I see a lot of a rush coming in from professional money managers who were like completely taken by surprise on this growth on NVIDIA. Now everyone is trying to chase NVIDIA so that they can post good results for the end of a year and, continue to use that as a card to increase the asset under management. So that's this NVIDIA is a great company. Their AI will be the next tailwind for all the businesses, not just NVIDIA, but all the businesses. But when I'm looking at from a valuation perspective, it's too expensive. That doesn't mean that the stock may not go higher. And if we looked at, you look at Cisco or CSCO, Cisco CSCO, Cisco Systems. Okay. But it has now breached back where it was, I think, way back in 2000. Or it has recently crossed where it was in 2013. Oh, come on. 2082 was a peak of the .com, and Cisco is still 55. Yeah, internet was the next one, next big driver for business, enabler for business. And whoever is supporting the infrastructure on internet were the hot stocks of those, of 1999. But eventually the value will accrue. And this is the cycle we have seen over and over again. A new tech comes in, internet came in, whoever is providing the infrastructure for internet, first the value accrues to them. Cisco, Exodus Communication, there was another few other data center related companies. Those were the hot companies. Next, the value start to come to those who are native, dealing specifically business built on internet. Right? Yahoos of the world, Lycos, search engines, or all those .com companies. Third, the value start to come in onto the companies which really has a staying power. The real business started coming in later, like Google's and the Netflixes of the world. And eventually, the value accrues to the companies which use this technology to enable other businesses, general businesses, to perform or to better using this new tech, which is what we are seeing with the Googles, with the Amazon, with all these companies which help other companies do better businesses. Saw the same stuff with mobile tech. Samsung's, BlackBerry, Nokia's hardware providers were the first one where the value came in. Next, started to move into the softwares other ones, right? Then finally, eventually to the companies that are building those apps or providing those gateways like Apple's, etc. AI, NVIDIA is again an infrastructure provider, value will first accrue to them, but these may not eventually be the winners in a long term from AI tailwind. So if you had bought Cisco at $80, even though Cisco has now been growing on their business at an average of 10% per year, which is almost 3 times what the S&P average growth rate is, it is way, way, way underperformed S&P. I mean, it hasn't yet met 80. It doesn't mean Cisco is a bad business. It's just that the hype was so much that the growth that was priced in at $80 was completely unrealistic. And even though Cisco has been growing at a very impressive 10% CAGR rate, if you had bought at that 80, you're still not profitable. Yeah. So that's my concern with NVIDIA is, I just can't wrap my head around how expensive the stock right now is. That doesn't mean that it's going to go tomorrow, will go down tomorrow. And I think that as an investor, that is a very, very difficult and tough position to be in, is how long can we continue to ride this? And when do we want to, I'm saying enough is enough. So I took a stand saying, okay, guys, I'm going to sell half my position and maybe use the other half to play with it. Cedric says, for NVIDIA, did you consider potential automotive division starting next year? All Mercedes-Benz vehicle will NVIDIA self-driving stack. The following year, it's JLR2. I mean, like I said, consider everything $350 billion, all the AI ones, right? Still, $400 is super expensive. Now let's add the automotive division also. I don't know how big $1 billion of worth of business automotive one is. And NVIDIA may, and they will have to find out new business. And if they do find out a new business, probably this valuation is justified. But right now, no one knows what new other big businesses as big as AI that NVIDIA will be able to find. They may be, because NVIDIA over years has pivoted themselves from being a gaming chip to a crypto chip to now an AI chip. And maybe they'll find the next wave to capture a market as big as AI. But today, that's just a hope on which this valuation is based on. NVIDIA gets chips from a TSMC and Samsung too. Yeah, these are the two biggest chip manufacturer. AMD is falling behind. Intel took a loss due to China rejecting merger with Tower. Yeah, I read that Intel was trying to do acquisition of Tower. That was rejected. All right, I think gone through all the questions. And again, if you have questions, feel free to maybe want to talk about those. Would prefer that. Could be much quicker. Want to turn on your video and we can have some nice discussions, fine with that as well. Or if you just want to type in, okay with that too. All right, so that's on NVIDIA. But will be good to see. And I'm just thinking what could happen on when the NVIDIA reporting result on 23rd, right? Say NVIDIA report results on 23rd and the results are, you know, whatever is market expecting, not really blowing the expectations. And what if the stocks fall down 5%, 10%? What happens to all those who have recently raised their price targets? I am waiting to see the reactions or the repricing of that, because it's so much fun to see these Wall Street firms trying to just catch up with the price. And we think, and I'm assuming that these people know a lot, but it is very difficult to hold on to your conviction. And not all analysts have been able to do it. And this is a pattern that I was reading, like I mentioned earlier, I just finished the book yesterday called Bulls and Bears, which basically is an account of some of those bear cycles and what was happening and what was the, chat in the markets, what the analysts were saying and all that. And it's almost the same stuff, just that the name of the companies have changed, the prices of the companies have changed, and the name of the analysts have changed. But other than that, 73s, in early 70s, similar behavior. 90s, similar behavior. .com, similar behavior. So this is nothing new. It is same cycle repeating again and again. The players have changed, but it's the same play which is happening. The actors have changed. So few analysts had the gumption to go against the wind in 1960s or, whenever in late 60s, early 70s, when Nifty 50 was the craze. And very few analysts have now can go against NVIDIA. GLR's delayed EV investment will fall behind. Tesla has advantage like Chrysler's had with their van. Okay. So since we talked about Chrysler, little on July 4th weekend, this time I rented Chrysler Pacifica. And my God, we were all surprised to see that Chrysler Pacifica. And my kids told me, Dad, this is the most spacious vehicle that you have rented, because even on the back seats, there is so much of a leg space. I'm like, I never knew. And I have rented other vans and other SUVs. But they all were like, next time you're going to rent it, please rent the same car. That's a little story on my own store on Chrysler and their van, Pacifica. We loved it. All right. So today, what do we want to dive into? I want to go through the report of Benchmark. Sorry, not Benchmark. BVP, Bessemer Venture Partners. And every year they create their Cloud 100 Benchmarks report, which generally talks about the companies in the cloud business and what they are seeing. Of course, we'll look into 13F filing of many, smart investors and see what they are buying or they have sold. And we'll also look at why you should not just believe what you hear from or see in social media, even if you're hearing from a reputed analyst, right? Many times we figure out that, they may not be right. And we'll look at as usual, go through macro stuff. We'll talk about China a little bit and whatever else you want to talk about. Okay, let me ask a question. I see some new names here, so I want to make sure I know what they are here for. So I see a name, and again, maybe if I didn't pay attention to you in a previous meeting, my apologies. I see Andre Durant. Is this the first time you're joining here?
Yes. Yeah, first time, yeah.
Okay, so what brings you here, and how did you find this group?
I'm looking into investing in the stocks and I've been kind of looking at like swing trading and options, and I wanted to kind of learn more, kind of see where like my research has gotten me. I'm reading some books, and so I just want to, the more information, the better, see, where I can get, so I'm interested in seeing what options is about, and it still doesn't completely make sense to me. So I'm trying to like see, understand how it works and everything.
Cool. So here's the case. If you have questions on options, please bring up. I discuss about option strategy once in a while, because what I realized was many other people, if you just directly jump into options without knowing which stocks or where you want to pick up or what you want to do, it's not profitable. But last week we talked about one strategy, how you can build 100% downside protection using options. I don't think I have anything for the content today. But if you have a question, feel free to ask anything on options. But generally,
Okay,
I do talk about option or the stock or how just be a good investor. Options is just one, in my opinion, options is just one tool in the overall toolbox of being a better investor. But that's not just the whole, not everything that I do. So let's say if I'm not talking about option, if you have a question, just jump in and ask. Okay.
Okay, I'll take.
All right. I see another name, Crystal Chen. I don't know. Maybe Crystal, you've been here before? Or is this the first time? Crystal. Just checking. Have you been here before, or is this your first time? Okay. Yeah, something. Yeah. Okay. If you're saying I can't hear you, you are unmuted. Okay. All right. Yeah. So maybe once you're my question is fixed. You can share what brings you here and what you're looking for. The reason I'm asking here is, just want to make sure that the session is useful. And if I see a lot more people just want to talk about, get deeper into options, maybe we'll do that, right? Just let me know. I mean, I've been doing it for what, almost 3 years plus, and we have changed the content multiple times. We've done sessions where we talk only about options, right? Options boot camp, focus, not talking about stocks, but only about options, how to use options, basics of options, different option strategies, portfolio protection using options, how to create an options portfolio, and so on and so forth. But it depends on what you guys want to talk, want to take away from this session. All right. So last weekend I wasn't here, and I would say the weekend was spent really well. I happened to meet a lot of folks that I admire, and I got myself a picture with my mentor/teacher. I don't think it's like I'm a silent admirer of Mr. Tom Sosnoff. I owe my option journey to him. So every time, whenever his team is in Bay Area, I want to make sure that I go and meet him, and that's my tuition fee to him. I mean, the event is free, but you don't have to go and meet, be there by 8 a.m. And it was a weekend spent well, I would say. When are we going to meet you? Whenever you're in Bay Area, just tell me. We'll have lunch together. And maybe if you have more folks from Bay Area, maybe we could do one in person. Let me see if you guys have appetite. Were you mentored by him? No, he and his team. So okay, a brief background about this person. If you don't know, his name is Tom Sosnoff or Sasnoff. He was a floor trader. He's been in options/investing for now for 4 decades, but you probably don't know, but he was also creator of or one of the founders and creator of Thinkorswim platform, which many of us use. And then they sold it to TD Ameritrade for almost $600 million. Then they went on to create 2 sister companies, Tasty Trade and Tasty Works. Tasty Works is a brokerage firm, and I do have an account with Tasty Works. And of course, Tasty Trade is a financial live streaming channel, and that's where, when I was starting my option journey, I looked at books, I looked at podcasts, I looked at YouTubers from not just from US, but even from outside of US, and spent countless number of hours in consuming the content. But then I hooked on to one series which was called Step Up to Options from Mike Butler, and there was one another lady with him. And that was the first time when I started to click, what the heck is that? Then I saw where they are from. Then I said they're from Tasty Trade. Then I started consuming their content. I'm like, okay, now it started to make sense to me on how to use options the right way. So and all that content is for free. So I never paid anything to them. So only 2 ways I pay my tuition is I trade on their brokerage firm, and I go and meet them whenever they are here. So, and of course, you email it to him, any questions that you have, they will personally respond to it. They respond to each and every email. It's now after selling Thinkorswim, they also sold Tasty Works to, I think, a European exchange for close to $1 billion. So he's like creates businesses and sell businesses, but pretty interesting person to be Pretty interesting person and a great businessman. Okay, so Bobby has shared the link for Tom Sosnoff. Yeah, so they do these shows in multiple cities in US. So this was like after COVID. It's almost a gap of 4 years. So I'm like, okay, I'm gonna go in and attend that. And good thing is I met a few more folks over there. So one thing which I want to share from that, from the tour was around, it is crucial to build a portfolio that is resilient to unlikely market turbulence without severely limiting upside growth during normal conditions. I think this is very, very important. As an investor, if you're new to investing, our whole focus is generally on how can I have a maximum upside. Right? That's what we look at. And whenever I talk to someone who's saying, oh, I'm an active investor, the first question that they generally ask of me is, what's your return on capital? What's your return on investment? What is AROC, annual return on capital? And that's a very tunnel vision to, if you want to start investing, focusing only on trying to grab maximum return. The good investors and the investors that stay for longer term look at how to make a resilient portfolio. That means, and there is no free lunch. You always have to give something if you are trying to get something. If you're trying to build a resilient portfolio, that means you may have to give up some of your upside gains. So instead of trying to knock 20% per year, 40% per year, I don't know, whatever you're trying to target, you may have to be satisfied with a lower percent, but to bring in more resiliency. And as longer I'm staying in the market, I think I'm becoming more and more focused on how do I not get wiped out of the market, or how do I protect, get some protection so that I can continue to be in the market for decades going on, because that's the only way compounding will work. Right? Charlie Munger says, right, that the rule to make a wealth is not to interrupt the compounding. And I've seen YouTubers come and go like a season. You will see some people claiming they made 100%, 50%, 60% for a year, and then later, 2 years later, you don't see them talking, posting any videos anymore. What I'm looking for, and I think as a great investor, you should look for, is to how to increase the longevity, right? How to make a portfolio that is resilient. So resiliency is very important. Managing risk is very important. New investor never used to think about managing risk. All they used to think about is upside. But a lot more professional investors, they think a lot more about the potential downside than the unlimited upside that you may be focused on. Market timing is not a reliable strategy, and drawdowns are almost certainly going to happen. In my young, I would say it's a young journey of options. I've already seen 3 drawdowns. So 2018, so I started in options 2016, almost 7 years now. 2018, then 2020, 2022. But all we have to make sure is, even if you are selling options, which is what I focus on, how do you not get these, when the market falls by 30% in a week? That's what happened in 2020. How you still stay in the game? How do you not get margin calls in which you have to sell the stocks even when you don't want to? That's everything about risk management. So if you're new to options, look how you manage your risk. The other side of the options is you do those option strategies and which is where most of the new people will do, is buying options where you have a risk is limited, but then you don't end up making money in buying options. No professional investor actually does long term. They actually buy options. Only the retail and option traders actually buy options. Most of the professionals, they always sell options because that's where the long term money comes from. But there is a risk component involved, and you have to just make sure how you manage your risk well. A robust portfolio may not experience as much growth during normal market conditions, but it will be in much better position to recover following a black swan event. So how do you make a resilient portfolio is what at least I'm focused on. Next, what we want to look at is something that yesterday evening on a Twitter feed, someone sent a link to me, not to me, but on their Twitter feed is, if you want to watch a video, watch this one. I really liked it. Here's a link if you are interested. This was I think probably a graduation lecture given by Alpine. It's a Wall Street firm. If you want to live an asymmetric life, do hard things. Easy things doesn't, there's nothing asymmetry when you do easy things or the things that everyone else does. Do your thing, what you are best at, or the thing that you like. Do it for decades. No success is an overnight success. Or let me put it other way. They say what people call it is an overnight success took a decade to come by. And then finally write your own story. There are two ways of living life. Living as a part of someone else's story, or we do the hard stuff and write our own story. At some point of a time, I think at least I've started to make a choice, guys. We're going to write our own story. Investing is hard. When I say investing is hard, not that the finding the stocks is hard. I mean, you can just pick index SPY. You'll do great in investing. When I say investing is hard, is to go through the motions of investing. Psychologically, investing is hard. The fact that you don't know what could happen in the future, the fact that the stocks will have a drawdown and you have to live through that drawdown, that is hard. Instruments are easy. People spend a lot more time in finding out which stock I want to invest in. And when that stock falls down 10%, so then don't even think 20 minutes or probably 10 minutes before they dispose of that stock. And then the stock probably will become 10x, and then they worry, I didn't make money in stock market. I lost money in stock market. Investing is not easy. It is hard. So do the hard thing, write your own story, and you'll be at least proud of what you did. Bobby says, do you recommend Tastyworks for brokerage account? I would like to consider if it is a reputable with a low fee. So Tastyworks has, their fee is not the lowest one. It's a $1 per contract with no closing, $1 to open a contract and $0 to close the contract. So if you are doing opening and closing, eventually it comes out to be 50 cents per contract. So that's not the cheapest one. But from a brokerage account perspective, they do provide some information which, let's say, is not easily available on TD Ameritrade. But if you're a big chartist guy, if you're a big technical analyst, technical chartist, I don't know, Tastyworks charts are not the best. Probably they would have improved it, but I've never used them. The reason is they themselves don't believe in charts. Right? But the things like IV, IVR, extrinsic value, all that is available upfront. What's your overall delta? What's your overall theta? I mean, on Think or Swim platform, you have to go to account summary to see that. But on Tastyworks, it's right there on your trading screen. So yeah, those are the pros and the cons. One thing which they have now implemented, which none of the others has, is to implement order chains. So if you roll your trades, they still track your rolling offer trades, your option trades, and tell you what the overall premium is. But it takes little time to get used to it because it's a little different than what you see on other platforms. But it's I mean, like I said, I've been their customer from day one. They only started their operation in 2017, and I signed up on a waiting list just because I wanted to pay my tuition fee. So, yeah, I've been with them from day one. So I use only two for my option trading: Think or Swim, TD Ameritrade. More over there, Tastyworks, my tuition fee. Okay, all right. So yeah, if you want to go and watch, this video wherein I just share the link. All righty. So I want to talk about, we talked about portfolio longevity and why it is important. And here's another empirical evidence. Sylvia Bloom, SYL. Sylvia Bloom, she worked for 67 years as a secretary in a law firm in New York, right? Not as an attorney, not as a partner, but just as a secretary. And so obviously not making the best or the maximum amount of money. She retired in 2014. But when she died a few years later, her executor discovered that her estate was worth more than $9 million. Right? Consisting mainly of common stocks. Some of it was common sense. She understood and took advantage of the magic of compounding or compound interest. Yeah. She wasn't trying to get rich quick, but trying to get rich slow, which is a much safer bet, which is very unlike of of the people that I meet. Everyone wants to make quick money. And you will find a lot of people trying to sell you the stuff that will allow you to make quick money. But no one has been able to make quick money for long term. And that is why even, what was in 2019, 2020, right? When everyone was trying to trade options, where was now I'm missing the name of the trio of the three best option traders in the world. One was Jason Bond. Gosh, I'm going to miss that. There are another two gentlemen, right? Because I watch a lot of content on option related content on YouTube, the YouTube will show me so much of ads of those three gentlemen. Not Najarian brothers. Najarian brothers were very much on CNBC, but again, CNBC is a marketing channel. It's not a financial channel. Let me put it that way. They will sell you and they will bring the speakers that is like flavor of the month. So when everyone was trying to do options, a lot of retail investors got into options through Robinhood in 2020. Najarian brothers will be on CNBC. Let me just try to find out. Jason Bond and they had a raging bull, like Jason Bond, and he had a few more other people. So anyway, so if you Google it, you'll find it out, right? And then only later on, I realized in 2022, they were all convicted by, whether was it SEC or Department of Justice, I don't know under which regulatory firm does it fall in, saying they never made any money on trading options. Only the money that they made was selling their useless courses to the retailers who are buying their option trading course or to trying to figure out how to make money in options, right? So for me, those are new to options. If you want to learn options, don't pay for it. There are tons of free content available to learn options. So unfortunately, most of the people who say that they sell the content, make money by selling the content, are not really by options. And And then they were convicted by SEC and to pay a few $100 million of fine, and then they've just gone off the YouTube. Najarian brothers, you don't send them on CNBC anymore, because now, hey, we had a bear market in 2022, and they have gone on CNBC also. CNBC doesn't want to bring what doesn't sell, right? It's a marketing channel, not really a financial channel. So start with Hasty Trade. I have, sorry.
Vivek?
Yeah.
The brothers, they made a call last year, or when it actually earlier this month, that they said this year that they were buying July 20 this year or last year 2022 Alibaba options, and that was a mistake. And then a couple of months later, you don't see them any longer.
Yeah, I mean, everyone, yeah. So getting one call off, I won't say that's a mistake, but just generally I've seen on CNBC is the guests that will bring in are the ones which eventually at the end of a day, CNBC makes money by selling the advertisement. So all they need is eyeballs. So if you bring in someone who is just saying, yeah, market crash, so what? There is no need to make any changes. Market is up 5%, so what? You know, how many people will actually tune into CNBC to see anything, right? So they have to constantly bring in the people who can give the excitement, who can keep you excited, but that doesn't really mean that that's a good way, that's a good for a portfolio. But that's good for CNBC because you'll watch them, they'll get more eyeballs. CNBC is going to make money through ads. So watch CNBC for entertainment, not really for financial advice or for a news purpose. But don't take whatever you hear as a financial advice. I'll get two examples. All right. No, on CNBC, I have only one right now. One was on long back. They brought some again, some portfolio manager or someone, and he was talking about Upstart, on why you should buy the shares of Upstart, why their firm is fully invested into Upstart, how great the business is, because Upstart in, I think it's 2021, was just going higher, right? And this is why sometimes I hate those people, is they just chase prices. And then one of the CNBC anchor asked them, tell us what this company do. And that guy was, sorry, what's the question? He said, what does this company business into? What do they do? And he was like, hey, I have trouble. I can't hear you. I had no idea what this company does. They're just pumping their bags. Because probably his firm had taken a position on Upstart, and now he's coming and talking about Upstart. So always take with a pinch of salt what you hear on CNBC. When someone on the CNBC comes and say, I think the NVIDIA is a great investment, or pick any stock, replace with any stock, you don't know. Who are they referring to? And that could be a Goldman analyst. Is he talking to his customers, which are, let's say, endowment funds? Is he talking to his customers, which are like family offices? Or is he talking to you as a retail investor? Or is he talking to a widow who's looking, okay, I got some cash, where do I need to put in? Or is it talking to a person, who is saying, okay, I need to put some money so that I can send my kid to college? We don't know who are they talking to. Each one of us are playing a different game in the market. So if you are selling something and I'm buying the same stock, it doesn't mean that you are wrong. Or people generally ask me, isn't it stock market is a zero-sum game? If you are selling something and someone is buying it, someone has to lose. And my answer is no, we don't have to lose. Each one of us is playing a different game. If you are a day trader, you will be ready to sell the stock if the stock falls 5% because you You're playing a different game that you have to make whatever your target is for the day. I may be playing a different game wherein I'm looking to hold it for a long term. And if its stock has followed on 5%, 10%, maybe it is available at a discount, I will buy it. We both are playing a different games. People don't understand that. CNBC doesn't know what or the analysts, when they talk about, give their price targets, say this is a good company to buy, they don't know who is watching them, what game those viewers are playing. So you have to be very clear what game you are playing. Understand before you understand stock, it is way more important to understand yourself. You need to know what game you are playing. And then find out someone who is playing the same game. Then I would say, then you can listen to them. But don't listen to anyone, because they may be playing a different game. I am here, could be playing a different game. That is why I always say, don't just follow what I say. Understand the thinking process and then apply it to the game that you are playing. Everyone out here is playing a different game. I might still pick Baba today, right? But I will talk about Baba. I find Baba is very, valuation perspective, very cheap. But I'm playing a different game. You shouldn't go and invest. But I might be picking Baba with 0.5% of my portfolio, and you go and pick 10% of your portfolio. Baba goes to zero. I'm still happy. You lost a bunch of money. We are playing different game. And that is, it pains me so hard when I look at social media and people trying to chase other investors. I'm like, guys, you guys are playing two different games. You can't do that. Well, that guy sells 4 day seminars for $5,000. Asif says, yeah, so he makes money from $5,000. Yeah. That is why I think I just give it for free. Our option boot camp, whatever those 14 sessions that I did, is freely available on YouTube. Right. All those 14 sessions I uploaded on YouTube. If you want to go and watch it, let me pull up a link. So it's on my YouTube channel. And again, I don't talk about it, so I don't have much following on YouTube channel. But that's fine, but it's available for free. If anyone wants it, do let me know. Hold on, let me just I do see 2 people talking about options. So hold on, let me just bring up that playlist for option bootcamp. Where is the last one which I did was here. Okay. So I think 13 sessions. So this is where we talked about how to start with the basics all the way to building a portfolio and how you manage your portfolio using options. Now, if you have questions around anything that I talked about in these videos, bring it here. Will be useful for others as well. Okay. Anirudh says, this brings me to a good question on how to navigate like these situations. Oftentimes the news is out. The price of stock is already adjusted. Either it goes way up or way down. So for a newbie, how to read between lines and make profit out of it, as well as invest in value-adding business. So here's what I focus on is, first I want to pick a business which I find is good, not the stock price, but pick a business which I want to own in my portfolio. And I wasn't that way, when I started it. I made my mistakes and I learned from it. Then I want to look at, what's from how richly is it valued right now? And that doesn't mean to say that if a company is richly valued right now, it's fall down, or it's not a good stock, because Amazon has proved everyone wrong. They've always been richly valued, but they have grown into that valuation. So even if it is rich, like I said, I don't mind rich valuation. I only think that I don't like is egregious valuation. If it is a valuation is fair, you can run DCF, you can run whatever valuation method you want to, depending on which phase the company is in its life cycle. Right? If it is a growth company, you can't value it based on, let's say, PE. right? Or you can't do a valuation based on dividend yield. If it's a mature company, you could do that. So find out which grow area the company is in maturity, pick up the right valuation metric you want to pick up. Then depending on where the company is trading right now, you can decide, maybe I'll pick up a very small portion of it, right? And then continue to add it. Because we trade options, we can actually give ourselves room for error, and instead of picking the stock, maybe just sell a put or a put spread, so that even if the stock comes down, I have a buffer. So that's where, and then it is very, very hard when you see the stock pricing going up and down on a daily basis. But somehow, I mean, you have to learn how to tune that out. It will take time. It is not easy. The other part is easy, which is finding a good stock. You can, I mean, there are a lot of services available which does a stock analysis. There are, if you are a technical chartist, probably you know how to find a right your pricing point, right? Hey, it is just hit a support level, maybe I'll buy now. If it is at a resistance level, I'll wait. Maybe if it crosses, does a golden cross, probably I'll wait for golden cross to occur, then I'll buy. There are hundreds of studies, whichever you are comfortable with, either from a fundamental perspective or technical perspective. But start small, don't go all in. The biggest problem is position size. All the stories you've seen where people have ruined their lives because they became too overconfident, went all in. And market will always humble you. ARK investments, for example, by the time they talk about a company has a value that they've already invested in, their agenda is different from what they portray exactly. But you may still not be late. If the company that is the business that they invested in, if it's a great business, I'm looking for anything which is like any company that I pick up, minimum 10 years of holding period. Otherwise, I'm not even interested in building a long-term position in that company. Otherwise, it's like I could do it just from a trade perspective, but anything that I want to hold in my portfolio is minimum 10-year holding period. And from that perspective, if ARK has pumped their bags and the stock has gone up 50%, but from my perspective or my analysis perspective, I think the business will continue to grow, I would still buy it. Not because the price has gone up, not because, look at the price, but hey, the overall, they still got a lot of runway available to me, a lot of growth available to them. The shiniest example of this strategy is Warren Buffett. He bought Apple, 2016, and he's done very well. Even if you had bought Apple went IPO, 1980, 1990, I don't even know. Like decades ago. Even if you had bought Apple 10 years after IPO, 20 years after IPO, you would have still done good. I got into Amazon only in 2017, and I was like, it's too late. But I was wrong. So, because it was still growing. So, you don't have to, there will be plenty of time to buy. If a company is good, there will be plenty of time. Again, the Ramesh say, I don't chase stock going up, wait for a couple of days, 3 days, see if the trend continues, buy a few to try. Yeah, there are some, if you look at someone use a 3-day rule, there are some other rule that I've seen is waiting for 2 days. If it fall down, I'm going to figure out what works for you. I am not 100% into this. So depending on how much time you have available, you can build your own strategy that works for you. For me, I want to start small. I want to spend time to understand it and maybe build a tracking position. Today, I'm going to talk about a stock in which I added a tracking position this week. When a tracking means, let's say, less than 0.5%. If it goes to 0, doesn't matter, because I want to spend some more time in understanding that company. VIN fast IPO is a good example. Not to fall for it. Kava is on the other end. Isn't VIN is the Vietnamese EV company? The stock was up, I heard 20? No. it was VinFast or something. Or VFS. Yeah, so it was like, first of all, it was a SPAC from 10 to like up 200% plus, and then like $15. So I don't even touch these companies. I mean, first of all, if you've been around, SPACs really don't turn out good. Anything which is coming through SPAC, you have a zero idea of what the business would be. If there are, I think it's a Lucid. They told that they'll be able to sell 5 billion worth of cars by 2023. And now that the number, they're like off 90% plus. When you come IPO through SPAC, you can say whatever you want to. So stay away from anything coming via SPAC. Anyway, if you are interested in Vietnam and this company, you'll have plenty of time. Let this company prove itself for a few quarters. You don't have to rush in. So coming back to Sylvia. So what Sylvia did, above all, she understood the concept of risk, right, which many of Ivy League investors even don't understand, and they blow up their hedge funds, is risk. How do you make sure that you increase the longevity in the market? Rather than trying to increase the return every year after year, focus should be on how can I stay continuously invested in the market for 5, 10, 15, 20, I would say infinitely, as long as you live, and pass it on to your heirs or to your favorite charity. That should be the goal. I've come to realize that the most dangerous facet of investor or overconfidence doesn't involve the ability to pick securities or money managers, but rather their ability to bear risk. And no one generally don't think about it, right? About the risk. Only thing we think about is what's the upside. No one has asked me when I talk about any stocks, look, what do you think is going to make 50%? No one has asked me, what do you think is the downside? How down can it go? We are not even hardwired to think. We are not even wired to think in that aspect. This is why investing is hard. In finance speak, our relative risk aversion is anything but constant. Let me just see. Sylvia Bloom weathered financial storms that would have shaken the confidence of 99% of investors. And within this group, I know we had investors, now I'd probably call them traders, who were part of this group when we started 3 years ago, because everyone was investor, everyone was Warren Buffett in 2020. And I don't see them anymore, because there are those 99% of investors whose confidence got shaken by the bear market that we saw in 2022. She did it by holding enough safe assets in addition to common stocks, right? This is where your cash comes in. This is why Berkshire Hathaway has so much of a treasury holding. Of course, there were two reasons. One is on insurance. They need to have a high assets enough available to pay for the claims because they own Geico. The other one is if you have enough of your side dry, I call it as a dry powder, that will make sure that when the bear hits, when the proverbial thing hits the fan, you're not lugged out or sold out of your portfolio or interrupt compounding because you kept a dry powder on the side. That's why I'm a big fan of holding decent amount of a cash on the side, even though that cash may not be earning anything. Today, that is earning 5%. But even if it was not earning 5%, like 2021, it wasn't making anything, I would still say hold that cash in your portfolio, because that saves your back end when the bad time comes and you don't have to sell the stocks that could compound during the subsequent years. So have some money on the safe, something on the sideline, so that you can continuously take advantage of that compounding. The lesson I take, what's the lesson? That is a huge and usually fatal mistake to design a portfolio without focusing primarily on the 2% of times which will cause you to lose nerve and violate Charlie Munger's prime directive of compounding. As Munger, who is Warren Buffett partner, puts it, the first rule of compounding is never interrupt it. That means holding plenty of safe assets. So you don't have to be PhD, you don't have to be an Ivy League person to actually build wealth. Building wealth is way more long time horizon, good psychology, and holding safe assets on the side so you don't interrupt the compounding. Everything else is a noise. Everything else, I would say, is a Vegas tables. Will give you enough of excitement. And there's nothing wrong in this. You can take 10%, 15% of portfolio and say, hey, this is what I want to use for excitement purposes. Right? But otherwise, we don't, the main area, you focus on reducing our cost base is owning good companies and hold it for long term. And let me tell you, don't feel bad if 50% of the companies that you own end up in losses. That's even a better metric. The other 50% will help, will probably pay way more than to compensate for the losses. If you're not doing analysis of individual companies, you have no business to own any individual companies. Then stick to ETFs. Then just stick to ETFs. If your individual companies are risky, you need to know what you're owning. You need to have the heart of iron when the companies fall on 50%. And if you can't go through the volatile moments and you don't track company during their quarterly results or at least twice a year, then don't own those companies. Stick to indexes. Perfectly fine. Great instrument. Just own SPY, which gives 10% on an average return. You hold that for 20 years, life will be set. Everyone talks about and wants to know why Warren Buffett is so successful. They want to understand his stock picking strategy. How does he identify this company as a moat? How does it look for what's the ROIC does he looking for when he's buying a company? How does he know what's the inherent value, intrinsic value of that company? One thing which people generally don't focus on is that Warren Buffett is successful not because he picked good companies. He's successful and is known throughout the world because he's been investing for almost 80 years or 75 years, like 3/4 of a century. If he would have retired when generally we retire, at the age of 60, no one would have been talking about Warren Buffett. Literally no one. But 90%, 99% of his wealth has come after that. But that's a fact that you don't see CNBC people talking about it. That he has been investing for 75 years. He hasn't let any market turbulence interrupt his compounding growth. And it's a simple concept. Compounding is a simple concept, but it's called the eighth wonder of the world because we are wired biologically to think in linear terms. We just, as a human beings, we can't think or understand the impact, which is like compounding stuff. And hence, even though we know, I read compounding formula in high school, probably middle school, but we just can't really understand the impact, how impactful it could be if we let it go. So first rule of thumb is try to protect your portfolio so that you don't have to interrupt the compounding. Otherwise, we are not letting the shares do their work. Sometimes we have to save our portfolio from ourselves. I know it's a little controversial statement, but we are, but it is true, that we become the enemy of our own portfolio because we don't have a control on our emotions. Asif says, was she work for corporate law firm? Was she not investigated for insider trading? Ramesh, BRKB bought in 2010 is up 400% and growing, which they had dripped to compound the growth. Yeah. Warren Buffett liked dividends, but he doesn't, Berkshire doesn't pay any dividends. Because, again, if you really look from as a CEO, the best job is to be a capital allocation, right? So Warren Buffett, only thing he does is he's a capital allocator. He doesn't run businesses, he just allocates capital. Now, when it comes to individual companies, what do you do with the extra capital? There are 3 or 4 things that a CEO or CFO can do with the extra capital that they have in hand. One is you reinvest back in business. Number 2 is you pay the dividends. Number 3 is you buy back the shares. These are the 3 decision-making points that a CFO/CEO has if the business is generating, let's say positive cash flows. They have a cash flow available. Now, it is better for a company to invest back in business if your return on invested capital is more than your cost of capital. And Berkshire knows that they can continue to generate more value by investing that extra cash back into businesses because of that fact. And hence that they don't give a dividend. If as a company, you're not able to find a good use, more profitable use for investing into businesses, then you better return the capital to the shareholders. You give a dividend to them. So I don't like a growth company paying a dividend or doing a buyback. Palantir announced that they got an approval to do a buyback for $1 billion. I'm like, what the heck? You can't find better use of that $1 billion to maybe invest in your growth. You can't find a company to acquire to turbocharge your growth in AI segment. Why don't you use that money to grow your sales team? Because Palantir is a little weak in enterprise sales. Why don't you use that $1 billion to grow your sales team and go and outdo all your competition? Because you are you are a growth company. But it's all, on Twitter, I see someone like, wow, Palantir has got a buyback. It's a great stuff. I mean, no, I would not like Palantir to buy back their shares right now. That gives me concern. That have they run out of any other opportunities? The whole valuation of Palantir is based on the future growth. So anyway, probably we will see what happens. They just got an approval. But that's how I look at a dividend. And mature companies, yeah, pay dividend to me. Because you are not growing your business fast enough, then don't keep the cash with you. Give it to me. I can find a better use of that cash. So other thing, what else can we do to not interrupt compounding is to use options, right? So that when a month like August come in, when your rest of the portfolio is down, at least you have some cushion available. And you don't have to think, gosh, should I hold this stock? Now the market is turning red. Maybe I'll sell this now and maybe I get back into later, which if you have been long enough in investing, that later doesn't come. Because once you sold the stock as 50, and if the stock has turned back around, it gone to 55, bet me you'll have such a hard time in buying at 55. And then you'll see that stock going to 80 and gosh, I missed it. So how do you make yourself and your portfolio resilient enough that you don't sell it at 50? Right? Sell covered call, sell call spread, generate some income. You can, I wouldn't say easily because it does involve tax, but it is no brainer to make 10 to 12% by selling, let's say, covered call against the stocks that you hold. And this is the easiest one. Right? If you're looking into that option bootcamp seminar, I think that's the second session I talked about, is how to generate consistent income using covered call. Right? Or if you have only 100 shares and you don't want to call away, do a call spread. And if the stock goes down, at least you made some money, right? Do it again. And the reason I got involved into options was just to make sure, how do I not get panicked and not resort into selling my stocks if the market is going against me. That was why I started searching for what can I do to be not at the 100% mercy of the market, because markets will go up, markets will come down. And that's where I started looking at what instruments can I use. I came across options, and that's where I got deeper into options, is how do I use it to build a little more resilient portfolio. So this August, while the rest of the portfolio has gone down because the market has gone down, and I hold a lot of growth stocks, and those have been like red from where it was in July, that is okay. A lot of the calls that I used to talk about are my hedging trades. Those worked best in August, right? So overall, like on those hedging trades, I made almost 5%. It got a cushion of 5% on my portfolio from those hedging trades. So it's still down, but a little less. You bleed, but you'll bleed less. That's the only thing is to focus on, so that you can stay longer. All right. And why you want to stay longer is charts tell everything. Probability of negative returns from 1929 to now. If you buy invest is only for 1 day, 46% chance that you could lose, almost 50-50, coin flip. Market go up or down. It's a coin flip. Want to hold it for 1 month, 38% chance that you eventually could lose. Hold it for 10 years, you have a 94% chance of success. And they don't have it, but 20-year SPY, pick any 20-year period in SPY, it has never lost money. Any 20-year period. So when you're trying to build your portfolio, try to make sure that you're building portfolio for 5 year, 10 year. That is why I said minimum holding period has to be 10 year. And then how do you say that if the stock has fallen down, but the business is still okay, then you don't panic sell out of it if the business is still performing. So try to play the game where you can win 95% of the time or 100% of the time, and not where your chance is less. You have a lot more sugar rush in 1 day, 1 month, 1 quarter, 1 year game. But I would rather go to Vegas to get my sugar rush and not go to stock exchange, right? Not go to my trading brokerage platform to get the sugar rush. So that's all. Focus on long term. And other thing I just wanted to, oh gosh, it's already 11:26. So I guess I hope this is useful. I know today we completely went off the rails and didn't talk about, we haven't even started on the real stuff. But I hope this is useful. What I find most is that having a good psychology is way more important. And that is why I stress so much on it. If you find this is boring, do let me know. Just send me a message. I won't feel bad about it. Say, hey, Vivek, enough of this. Let's move on. And I will. Okay. but I find this is way more important for long-term growth. Not last week, week prior to that, we talked about an option strategy, how you can construct to get 100% downside protection with the caveat of what you give. Over the next 2 years, you can have maximum 14% upside gain. And then I also talked about an ETF that will allow you to do it. Right? So, and yesterday night, I came across a YouTube, which was YouTube video, which was released yesterday. And there are personalities which you will see on CNBC many times, right? Josh Brown, run registered investment RIA firm. Eric Balchunas, he is the most respected senior ETF analyst with Bloomberg. So about any ETF, you will see Eric very active on social media. He'll be on CNBC's. Jeffrey, he is a CIO of Wisdom Tree. Wisdom Tree is issuer of many ETFs. Wisdom Tree has a lot of ETFs in the market. They're an issuer. And then there was one, I think, Mike. What surprised me was they talked about the same stuff that we talked about 2 weeks ago, is 100% protection. And if you bear with me.
Why don't your vibes like them?
Okay. Yeah. So let this ad go through. And what shocked me, that these experts were all surprised and had no idea how the stuff works. And I was like, you guys don't know about this? And then it is okay. It means at least in this session, we're discussing something which is which is, I would say, a little esoteric. Even the folks like Josh Brown, Eric Balchunas, etc., they don't know how the stuff works. So just here.
Over the next 2 years, gross of fees, I think the fees are 75 basis points, so 14 and change, whatever it is. And if the market goes down, you're not exposed to the downside. So you get up to 14, right? If the market's up 7,
It's a cap.
it's a cap. So if the market,
This is what exactly we talked about. And we also built out that option strategy of, instead of either you buy this ETF. So they are talking about an ETF that was released, that also we discussed. But I also talked about, if you don't want to buy the ETF because then you have to sell your holdings, you go capital gains tax, how you can use options to actually do exactly the same thing.
market is up more than the cap, and the market's up 30% on the next 2 years, you're not going to get more than 14, 16 minus whatever the fees are. But if the market's down 10, you're not exposed to the downside. The fact that you can choose what is the market's up 40% and you don't get the upside of
That's it. That's the whole risk.
What else?
No, let me describe a few things. We do have a few.
So Josh Brown was, how the heck is possible? There has to be some catch. And I'm like, okay, that's why you have to be careful on what you hear on CNBCs. They may not know the whole story. I mean, not that Josh Brown should know everything, but at least I expected Eric and Jeff to know the inner workings of how these ETFs are constructed. But I guess we have to do, that's why we have to do our own study. All right, final one, or compounding. And this is the chart I'm bringing here because I also shared with my kid. I'm like, hey, you're starting your journey. You have a 30-year investment period. You start your initial investment with $30,000. Pay $100 monthly, right? Which I guess will be, if you're making a decent wage, $100 shouldn't be a big, I would say, not a huge burden on you to invest, right? Start with 30K, $400K per month, you end up making $820K after 30 years, assuming you don't disturb the compounding. Right? I have assumed 10%. Oops, I made a little bit of a mistake. I should have done compound frequencies. Where is there a chart? Let's look at the one. So start with 30,000, but I guess the mess is compounding annually. And which is what SPY gives. If you do it for 30 years, okay, not 820, but you still, by the time you retire, you have a decent nest egg. $100 per month, starting at 30K, right? And let's say you say, cause I don't want to start investment now. I want to enjoy my first 10 years of life, want to spend, travel world, do whatever I want to. But those 10 years could cost you a lot. So let's say if you, instead of doing your only 20 years, see the difference? It's like 1/3. And now if you were to catch up to it, let's say you and this is the logic which is generally, I don't want to start now, I'll do it later, I'll be able to add a lot more money, I'll start with a lot more, and I do double of this, and I have only 20 years, I'm still not able to catch up. It's just the power of compound. You have to give your investment time to work out. And here's the crazy fact. Just started with 30,000 and hadn't put anything. That's it. And had let it grow for 30 years, you would have still come out ahead. Even if you started 10 years later and trying to add double the amount. These stats, and if you have someone who's just starting their investing journey, share it with them. You know, it is difficult for us to think in exponential terms, right? But it does work. YouTube link. All right, this is the YouTube. Okay, the two links are I think that the below is the one which is the recording of our last week episode. This is from the one which I shared, and this is where I think last week I talked about the same stuff.
Right. Downside protection ETF.
This is the last week. So all right. So enough on that one. What happened on the macro side this week? Little bit of breather. We are down 5%. SPY is down 5% for in month of August. Not a big deal. It is still up 14.6% year to date. Like I said, you had gone on a vacation. You had no internet access at the end of 2022. You came back to your town now, and you're up 14.6%. Great. So don't look at the relative one. On an average, SPY is only 10%. And I understand last year it was down 18%. So it's still catching up with it. But I would say this is the pullback is healthy. We needed it. Tech is up still 35%. It was what? It was up 45% as of last, I think maybe by end of July or 2 weeks ago when we last reviewed it. Now it is up 35%. Why? Slowing growth, real estate troubles in China. We will talk about China. I will talk about real estate plus others. US Treasury yield rose. Now I think 10-year is 4 point. What is 10-year yield right now? Ten years 4.30. So why would we? And if you're happy with 4.30 return with zero risk, why would you want to be in equity? And that is the case. A lot of money is moved into money market funds. I think I have a chart for that. Last week, the recession is back on table. And this is what surprised me. Based, month to month, the discussion of recession keeps on changing. Now the recession is back. The discussion around, hey, probably we will have a recession is back on table. Last week report shows weakness in vehicle sales, building permit tell us that the impact of Fed rate is working through the economy, which is what generally takes 12 months for the rates to start to work into the economy, so I'm not surprised. And now the yield curve started to steepen. So yield curve was inverted. Now we have started to go back and try to steepen it. Generally, that's where we see the recession. Even if we go back and look into the past, when the yield curve, after being inverted, when it started to go back up, that's where a lot of recessionary stuff started to come in. So nothing new. An article in Wall Street Journals, peek into earnings. Look at this. These three earnings decline. And if you've been thinking, and then we've talked about here is, guys, the earnings is declining, or for the whole S&P, quarterly earnings on an average is declining. The market is going up. Just doesn't make sense. But many times market, behaves in a way in which it's difficult to put two and two together. So still, from an earnings perspective, the estimates have been coming down. Second quarter earnings changed from a year earlier. Consumer discretionaries are all up. Energy was down, obviously, because in 2022, energy made a killing. Now, when you're looking at the relative, energies were down, materials, healthcare, they all were down. This is not, I forgot to update the sector-wise. Okay, this is another interesting chart on big picture 2023. So this is starting off 1925. Growth, if you invested $1,000, growth is whatever, 10 million. US stocks, growth portfolios 4, balanced portfolios million, international 1.3 million, income 372, bonds 98, T-bills this, and tips is 16,000, right? What was I wanted to? So again, I think looking at the big picture, I know a lot of talks of recession. What should I do? From a recession perspective, should we go in? Should we go out? If your portfolio is structured that if you don't have a money that you need for next 2-3 years, which you should not have in the market, then I would say stay on, reduce your cost basis, and ignore the noise that we are seeing in the market. Even if we have, and in between, we had everything. Right? We had COVID, we had 9/11, we had a recession, we had a lost decade, we had 2 world wars, we had a Cold War, we had 1987 crash, we had everything. But if you structured a portfolio that you don't need anything for next 2, 3, 5 years, then I would say no need to panic. Even if let's say market goes down, which I don't know, which none of us knows whether it will go down or not, but reduce your cost basis, options, use that to continuously reduce your cost basis. It is impossible to time the market. Only market timers, only folks that I've seen can consistently time the market exist in Twitter or YouTube. They don't exist in the real world. So I don't even want to try to do this. Where did I get this big picture chart? I got it from, I think it's Brian Feroldi. I think he had posted it on Twitter. But there's a lot more information in this one. PE ratios, 24, still expensive from a historical perspective. And that is why I'm still being cautious. That means I still hold a lot of negative delta trades, hedging trades, still have it. Overall, portfolio is still positive delta because I'm optimist, but trying to add some cushion in case the market goes down, which I don't know. If it doesn't go down, it continues to go up, yeah, we'll make money. If it goes down, I'll lose less. That's the only thing. Fear and greed index. 2 weeks ago, we were in extreme greed. Then August 4, we were in extreme greed. Then August 18, oops, no, it's a different one. July 7, we were in extreme greed. 2 weeks ago, we were in greed, and then neutral. So still, is it a time to buy the dip? That's another question. I don't think it's a time to buy the dip. Generally would be when market moves into fear or extreme fear. And I've shown, even in earlier sessions, plotting the sentiment with the SPY. And that's one good indicator is whenever we have seen time and again that after it moves into extreme greed, we do see correction coming in. So yeah, now the market is coming back into neutral territory. We'll see how the next week goes out to be, but I'm not buying the dip right now. I mean, still doing the regular stuff of the regular investment and selling options to reduce the cost basis, but not taking money out of my cash position and moving on to the stock just yet because, hey, it's down 5%. I think there's still would want to see what NVIDIA brings to the market. All right, I'll skip this one. So what did I buy or sell this week? Just want to be transparent. GM put was assigned, bought SE, which is and I'm going to say South Sea, which is not right. That's the South Asian Sea Limited. In gaming, in e-commerce, basically gaming, e-commerce, and fintech player in Southeast Asia. This stock was punished because their gaming revenue went down, but that was expected. Garena wasn't that because India kind of banned it. They thought it's a Chinese app, but their long term, I think, still okay. So I added some position, bought some little bit of a KWeb, which is a Chinese ETF. Snap put was assigned. I opened a tracking position in a company called Adyen. Not many people know about it. It's a European-based company. It's a payment processor company. So I opened an initial tracking position. I'll talk about it, why I opened it. NEO, Chinese EV, I had a put which got assigned, and I have a covered calls against it. And INDA, which is India-based specific ETF, I added a little more to my position. Sold nothing. And these positions are the stock positions, not the option trades. Of course, tons of option trades also. I do want to spend maybe some time or do a research on IJH, which is mid-cap ETF. The fact is that the top 7, Magnificent 7, has carried the stock, the S&P where it is today. But how about the others? How do I now say, if I want to, I think those top 7 have run up too much too soon. Probably others have to catch up. And then I want to focus on that one. Yesterday, I came across this ETF, which is S&P mid-cap ETF. Maybe I'll try to research it. Obviously, bond investing is interesting. Why do investors not want to buy bonds? Because bonds haven't performed. Investors, when I say investors, generally investors chase what's working in the market. Look at SPY, up 14.62. Look at NVIDIA, up 200%. Look at bond, TLT, 20-year bond, down 7.5%. 20-year plus bond ETF. There's another ETF I looked at, which is 10-year. Forgot what was a 10-year ETF. That's down another 3%. 10-year ET Treasury ETF. What's a 10-year? IEF. IEF. It's down 3%. So, I mean, the gist here was investors are not buying bonds because bonds haven't worked this year. Even though the bond yield is right now, its yield is great. But when you see the green, again, bonds work the same, right? So if you buy the bonds, you're gonna get the stated interest after the maturity of the bond. But in between, anything could happen. Right? And if interest rate, let's say, continue to go higher, the bond will lose value. Even though you, at the end of your maturity period, you will get whatever the promised return, but you will have that intermediate loss, and investors don't want that. So investors rather are putting their money in money market funds, which is fine. So the whole article was, bonds are so attractive, why the investors are not buying it? Because stocks, we know, we've been tuned to think that the stocks always come back. But when it comes to the bond, investors generally, the feeling is it's a safe investment. And if they see the bonds going down, they're kind of, what the heck happened? Right? It's like a deer in the headlights. You don't know what to do with that because you've been told that bonds are the safe, it's a safe. So if your stocks are not performing, bonds don't lose money. But in fact, bonds have lost money this year. So the whole concept of how the bond reprices if the interest rate goes higher is difficult for individual investors to understand. But I've been buying TLT because I don't know how long this interest rate can continue to go higher. I mean, interest rates start to come down. You will see the bonds like TLT and IEH, whatever, long duration bonds will start to go up. So yeah, people are not buying bonds. Roblox as well went down the drain. I hold Roblox, a small position, but again, they lost 21%. I didn't look at what their earnings was. Do you know what happened during their earnings? Was a weak guidance. Most of the times when I see stocks that have been punished, is not because the recent quarter results were bad. It is because the earnings the guidance wasn't that great as what they thought it to be. User-based shrinking. Okay, that's not good. But I think, was it Roblox or was it Unity? Some of them did a tie-up with Apple. Probably it was Unity. So why did I buy Adyen? Again, I'm not on a deep dive, so that's why I only did a tracking position because time and again I've seen that the stock that I've heard about it went down. I'm like, okay, I'm interested. Let me spend some time on it. Then I forget to spend time on it. I never bought the stock. And then it came back up. Then, oh gosh, why did I not buy it? So this time you learn with the mistakes. So I'm like, I need to at least add a tracking position so that it shows up on my portfolio. And I'm like, I need to do an analysis on this one. So I added a tracking position on Adyen. It's been on my watch list for quite some time. I heard about their good, about the business that they built in Europe around the whole payment. They're kind of a payment processor. Sits between MasterCard, Visa, and your issuing bank and all that. They're merchant acquirers. If you understand how the whole space works, probably we can get deeper into some other day on this whole space of credit card, all the parties, and what's the use of each of those parties. So they're in a provision of payments platform business. They have online payments, point of sale, marketplaces. They have operations in Europe, Middle East, Africa, North America, Asia Pacific, Latin, almost, I think, everywhere. They are dominant player in Europe with almost 20 to 25% market share. which is huge. Now they're expanding in US and have less than 5% market share in US. They found that the US is very, very competitive. The reason I bought it, this stock was on 40%. And when I've heard about Adyen earlier from that it's a great business, not the stock price, but the business is good. The management is good. And then when the stock fell down 40%, I was like, is it a buying opportunity or is it a falling knife? Is it a value trap or is it a buying opportunity? I don't know because I haven't looked at the business yet. So either I wait to look at do those deep dive, the full analysis, or I thought maybe let me add a tracking position, which is even if it goes to 0, yeah, I'll probably have a small cut. It's not a wound, it won't hurt me much. But if it is, come back up, at least I have something. And number 2, it's remind me if I see in my portfolio that I have to do a deep dive on it. So why it fell down 40%? That they found that the US is way, way, way more competitive. They had a margin pressure between last year and this year. And this being a Europe-based company, I think they're based in Netherlands. Yeah, they're headquartered in Netherlands. They only report the result twice a year. First half, second half, no quarterly results. So margins were under pressure in the first half because they hired a lot of people in 2022, which I found was a good strategy. And I'll talk about it. When everyone was hiring in 2021, when all the tech companies doubled up on hiring, Adyen didn't hire at that time. So they were not competing against these big tech companies to pay, through their nose to get the good engineering talent. Now in 2022, when everyone else was firing, then they went in the market and started to hire the people because now they could get at a much cheaper rate. There's not much of a competition, and build there to invest into the product development. But what that caused is a margin pressure. Number 2, it is in a commodity business. Payment processing is a commodity, right? And there are in US, Europe is a fragmented space. I don't think I have a chart here, but I think that's what I'll use that when I finish my deep dive, and then I will come back and share. Europe is a very fragmented space. There are at least 15, 20 players in Europe. So it was able to command almost 20, 25%. US is not fragmented. There are very fewer bigger players. And I didn't even know that JP Morgan is like one of the biggest ones. I know about PayPal, Braintree. We talked about Braintree earlier. Stripe we know. But I was so surprised that JP Morgan is the biggest player in payment processing. It's in merchant acquisition business. So what Adyen now found out that the strategies that worked in Europe is not going to work in US. Right? You just can't rip and replace the same strategy when you're entering into a new market. It's a different market. So they're like, oh gosh, it's so difficult to grow in US. The reason market could have punished them is if you're not able to grow in US, where's the next growth story come from? Right? You're already 25% in Europe, not much scope there. You're finding difficult to grow in Europe, US, and I think that's why they punished 40%. So for me, either it could be an overreaction or market could be right. Either ways, I don't have a big, horse in the race. So I just added a tracking position, and I'll wait to do my analysis, understand more about product, understand more about the management, competitive landscape, and then see, do I need to add it to my position or is just a lottery ticket that I bought? And when you're investing in lottery, you only invest very, very small portion. So I don't know, it might turn out to be just a lottery ticket. Or if I find that maybe I think the business is still fine and it might be able to add a little more to it, and then I'll come and share. What about PAGS? Which is PAGS? Other one, do you buy OTC? OTC is charged a fee, is it or not? Yeah, they charge me $4. And that is why, because it trades only in OTC. Number two, it doesn't have options. So which is again, I generally don't want to buy the stock which don't have options enabled on it, but the 40% drop was too much. And this is anyway just a tracking position. So I went ahead and did it anyway. But yeah, it charged me $4 to buy this. What about PAGS? I don't know about PA. What is PAGS? I have no idea. This is a Brazil-based, is it merchant similarly payments platform? I've not looked at that. So why it doesn't show up on Finviz? For whatever reason, it $2.93 billion company. Let's see if I can find something. PAG, I've been around for some time. That's cool. Revenue growth looks to be impressive. Oh, this is in millions of Brazilian real. So this is not in US dollars. They continue to grow. Let's look at a quarterly. This is a little concern to me. Is the slowdown in their revenue growth. I mean, they've been growing impressively. And now the last 2 quarters, slowdown in their growth. Overall, of course, I don't expect them to. How old is this company? They've been there for, at least it's since 2015. They came IPO in 2015, looks like. Billion real on balance sheet, cash and cash equivalents, 2.93 billion real. Okay, long-term liabilities, net cash down. They've been able to make some operating cash flow last year. Don't know what's the status quarter to quarter. They did a lot of capex this quarter. So no free cash flow because they did a capex. What's their it's not too expensive. Is it not too expensive because of a reason that the growth has slowed down? That seems to be the concern. Over at least for the last 2 quarters, the growth has considerably slowed down. So if I were to play in Brazil, and it could be because maybe, and again, I don't know. I'm not looked at the Brazilian market specifically, but I don't know. But we talked about Mercado Pago when we did a Mercado Libre results, and they have seen some good traction in Mexico and Brazil. Now, what I didn't look at that time, and probably is maybe time to go back and look at it, did Mercado Pago, which is their payments platform, did it increase its payments share in Brazil or not? Because they had some good results coming out of Mexico and Brazil. And is that a reason why PAGS did not grow in the last 2 quarters? This is a concern to me. So if the valuation, I mean, from a valuation perspective, it seems to be not richly valued, but there's a reason is the growth has slowed down. Other than that, I think, let me see how was their OPEX. So overall, OPEX is $489 million, and they have a 4 or 5 years of OPEX. Balance sheet has got enough cash to survive for at least 5. Oh, that was a quarter, right? For 5 quarters. So liquidity wise, I don't have a concern. My only concern is a growth wise. So how the share market is done? Shares have done. Yeah, so this shows up from a growth perspective. The growth has slowed down. So I don't know what's your thesis. Is this was valued as a growth company, and when the growth starts to slow down, that's the reason why you see this being punished in the stock market. Now the question is, we have to get deeper into why the growth has slowed down, and if it is because of a competition from others. And then this is a commodity business. Unless you create the whole platform to lock in the customers, and Adyen has got some big customers in US. Netflix is Adyen customer, Microsoft is Adyen customer, Uber is Adyen customer. But what this big customer also do is to squeeze the margins out of you. And that's a hard lesson that Adyen is learning here. But we'll see. I do want to do a little more deeper dive into Adyen before I add more to my position. So China, what's up with China nowadays? All right, so we hit our 2-hour mark. So I'll go through China and then we'll quickly look at 13F filings and we'll call it done. The Cloud 100 benchmarks report, let's do it next week. I don't want to take more of your time. I appreciate you guys still being around here for almost 2 hours. Want to be cognizant and respectful for your time. We'll do that next week. So what's up with China? Number one, Biden's administration came and told, let's not invest into companies that are in high-tech sector of China, AIs, machine learning, face recognition, chip manufacturing, and all that stuff. China also retaliated and say, we're going to ban rare earth metals. So again, this political pull and push will continue. Both the biggest economy and the second biggest economy both need each other. If we say, we're going to completely cut off China from the chip supply chain, China could ban the export of gallium and germanium, which is needed for creating integrated circuits. And 94% of the production of gallium happens in China. Go ahead.
Number one, didn't China already say they would ban 2 or 3 minerals, including gallium? And number 2, most of the production is done in China. I mean, they should just ban it for export.
Yeah, so again, they have not kind of a banned export. They told that whoever is exporting it now need to obtain a license. And then let's say if I want to sell it to a company in US, they just won't give me a license. So yeah, so China retaliated and say, okay, guys, now we are asking all our companies to obtain a license. So same thing happened we did with Huawei. When Huawei was put into the sanctions list, now if you are doing any business with Huawei and you are exporting anything to Huawei, you need to basically get an approval, which means, no one will do that. And essentially companies stop doing business with Huawei. Now, same is the case with gallium or germanium. Probably, I think for us, at least the US might have found allies in Europe who will have, from which we can secure these rare earth metals. But this thing will not continue for long. If 94% of gallium, which is used in LEDs, photovoltaic panels, integrated circuits, if that is all being 94% of that is from China, then we need China. China responded by blocking Intel merger with Tower Semiconductor. Yep, they also did that. Other thing on China, Chinese government coming back and saying we want to help private sector. The reason is, I think, let's go through maybe that reason first. Let's go through this one first, because this you see in the news, right? China economy is in woes, pretty bad situation when it comes to the real estate. Evergrande, I don't know what you call. So they filed for bankruptcy, Chapter 15 bankruptcy in US on Friday. Not that no one was expecting, but whenever there's a bankruptcy coming from one of the biggest real estate developers in China, it's a huge thing. Youth unemployment in China is increasing because China has a lot of college graduates. They don't want to work in manufacturing. They want to work in service jobs, which you don't have enough on in China. What I also heard, and someone, family probably can correct me, is government is kind of, exhorting the youth to come and say working in manufacturing companies is a patriotic duty. So don't, don't sit idle and say, I won't work in a manufacturing concern because I got a college degree. I deserve much better job. I deserve a service job, a desk job, and not a manufacturing job, which is a little in harsh conditions, right? It's certain patriotic duty to come and work in factories. So youth unemployment have increased. Last number I heard was between 20 to 24, around 20% youth unemployment between that youth age group. And China has found, government has found to fix in its own unique way. Can anyone guess? What's the unique way that China said they're going to fix this?
They just don't print it.
Exactly. So I was a little sarcastic. They say from now they won't report these numbers anymore. So your unemployment just vanishes.
Vivek, in 2011, some guy from Peking University, that's kind of like the Yale of China or Harvard. It was noted that he went to work at, wet market. Yeah, you know what a wet market is. Maybe you could describe it to the people. So he just took his father's business, and rather than going for a glitzy, 10,000 RMB job per month, he just took. So it's kind of interesting. People are very spoiled this generation now because, people will go for work for everything until, I guess, 2015 or till now.
Yeah.
I just want to give you some insight.
So, yeah, and I guess, I think eventually people will go back to job once the savings start to run out. But if you look at a recent report from Alibaba, JD.com, and forgot the other company, which are more consumer facing, the business is doing great. So while we are hearing a lot of stuff around China economy, all we are hearing is because the real estate is a big portion, right? Let's talk about here. Real estate is 30% of the country's GDP. And because of the bankruptcy and another one which is just now coming up, I think Country Garden, they're again a big real estate developer, and they're saying maybe we'll not be able to pay our US denominated debt. Little bit speculations around that the real estate is in trouble. and that consumes a lot of headlines. But if you look at the BABA results, JD.com results, consumers still had cash. Of course, the growth that we were expecting, saying when the China economy reopens, and China was the last one to reopen their economy after COVID, everything will be hunky-dory, like the things happen in US, business will make tons of money. That hasn't happened yet. But I was surprised by the BABA results. They printed so much of a money. The cash flow is like up 48%. Adjusted EBITDA is like up 78%. While the companies like Amazon is growing at 5% rate in US, BABA was up like 14% revenue growth. So consumer, at least for the last quarter, seems to be still strong. And that's why youths like, okay, I got money, or maybe my parents have money, I'm staying with my parents. I don't want to go and work in this factory job. And that may be a reason why the youth unemployment is still higher. So what Chinese government is saying, they're pledging some financial help even to the private sector and also to attract foreign investment. And they also cut the federal rate by 15 basis points, which I guess 15 basis points are like, it's not going to move the needle, right? But I think it was more of a symbolic move to give an indication to the market, saying government is not just sleeping on this. We're gonna help you, and they cut it by 15 basis points. The other thing which I heard on Friday was they kind of a banning short selling Chinese equity. I don't know how far this is true, but some version of it by the banks, which PBOC, the CCP controls. So now coming back here, what measures to help private companies? They, on last Tuesday, rolled out 28 detailed measures in terms of how are they going to tackle and help the private sector, which is very different from what the China stance was in 2021. In 2021, Chinese government was, I think, late 2020, 2021, that time frame. Chinese government was like so much anti-private, especially big tech companies, that it was almost impossible to for Alibaba and the likes of these companies to make good amount of money in China or to grow in China. We saw this with Baba. They blocked the IP of Alipay. Baba was hit all-time high of 320, and they blocked Alipay. Jack Ma made a statement, learned his lesson, he disappeared from public for some time, went to a reform school, and then we saw a lot of measures from Chinese government to rein in these big private sector tech companies. Now they're being opening up and being more receptive in trying to help them, at least in papers, they've come back and say, we're going to help the private companies. Again, China is a big company. So China is a big country, we just can't ignore it. I mean, all this political rhetoric going on between Biden and China, we have seen that during the Trump time also. So I am interested in, again, you have to be cautious when investing in China, is everything is dependent on controlled by CCP. Whether it is any private company, whether it is Alibaba, JD.com, Pinduoduo, I don't know, whichever you are interested in, at the end of the day, every company is controlled by CCP and you have to be comfortable with it because CCP can do whatever they want to do. But if you are okay with that risk, and if you size your portfolio or the Chinese portion of your portfolio, assuming and understanding this risk, I think there is a value to be found in China. I mean, if you look at it, top 5 countries in terms of Fortune Global 500, 142 are from China. And this is coming from Fortune Global Research, and only 136 from US. So it's not that the second largest economy will just disappear. Yeah, right now there are problems. Understand it. Real estate was a big one, and that's why catching all the news. But you find the best deals in when everyone is looking for an exit door. So for those brave souls, Baba, I looked at Baba result, and like I said, revenue increased 14% year over year. Income from operations increased 70% year over year. Adjusted EBITDA increased 32% year over year. Net income non-GAAP increased 48% year over year. Free cash flow increased 76% year over year. So, and Baba is right now almost where I think where they went IPO. What their IPO was $80 5-6 years ago. Maybe this is the max. Okay. Not they went IPO in 2014. $90. So now it's just below IPO. So there's a value to be had, but be cognizant of all the risks that I talk about. It's not a financial advice. You need to understand what you hold in your portfolio and what the game you are playing. I'm playing a different game. Okay. So I bought KWeb, like I mentioned, and I will continue to sell options. I have a strangle in Baba, which is now in the money on the put side. I think my strike price is 95, almost $6 of premium in it. So break even will be $90. But the result seems to be good. But the biggest worry is it's in China, controlled by CCP, irrespective of whatever the executives might say, and you have to be comfortable with that risk. So that's on China. Lastly, I'll skip this. Let's look at 13F filings. Third point, Daniel Loeb's third point, new stakes in NVIDIA, TSM, I understand, getting big on the chip side, and Amazon, top 5 position, PCG, DHR, Amazon, BBVA. I don't even know what BBVA is. Okay, I'll quickly go through it if you have any questions. I mean, I don't know much about third point, but if you have anything that you want to talk about it, feel free. Appaloosa, NVIDIA increased by 580%, right? Everyone is now trying to chase NVIDIA. And mind you, this is as of end of June. Now this is at end of Q2. Now we are almost 6 weeks into it. They could have sold it. So don't assume that they are still holding it. This is as of end of June. Added to Meta, added to Microsoft, Amazon, and Alibaba, added to Baba, what, 5,000%? Let's look at how much do they hold Baba. So it looks like they had almost nothing. And yeah. So 99% they just added in Alibaba. NVIDIA is the top one. What else? NVIDIA, Meta, Microsoft, Amazon, Baba, Uber. Anything that name that we don't know of? No, nothing that I'm just looking at is there anything obscure? Nothing obscure over here. Altimeter Capital, it's a VC firm which invest in public market. They are kind of this is what's in VC terms called a crossover firms, invest in both public as well as private market. Their top positions is, what did they buy? Confluent and Amazon. This Confluent is always tricky for me. Anyone out here own Confluent? Anyone, any Confluent lovers here? On watch list. Yeah, I've been kind of a, once bitten, twice shy. Stuff is, I don't know how long Confluent growth runway could be. They are a single product company only on data streaming, based out of, build it on Kafka. They don't command the whole value chain, if I may say. There's one portion of the overall data strategy for any CDO, right? So I haven't been able to put in anyone in Confluent yet, but yeah, good to see them, Apple, Altimeter adding to Confluent. Top sales, Google, and I think this is global something. So Snowflake is the largest one. Meta, Altimeters, the CEO, Brad Gerstner, wrote a public letter to Zuckerberg, and that became very famous in Twitter when, Zuckerberg told that they're gonna spend countless amount of money on metaverse. He was furious and wrote big letter to Zuckerberg. It was an interesting read. We discussed that here. Confluent, Uber, Microsoft, Nvidia, Roblox, Amazon, nothing that I don't know of. 0.72, this is Steve Cohen. After he was banned by SEC to manage other people's money, is like, I'm a billionaire. I'll just create a hedge fund just to manage my own money. So increase Nvidia position by 67%. So now, where is Nvidia? It's the topmost position. Ignore the SB buy put. I want to talk about that, and we'll finish the session there. One Michael Burry. Do I have a separate one for Michael Burry? Okay, so let me finish the others, then I'll come back to Michael Burry. Berkshire Hathaway, new positions, home builders. And when it comes to the home segment, only thing that is selling is the newly built home. Existing homeowners will not sell their homes where they have a 3% or less mortgage and buy a home and pay 7%. So the only homes that are working out are the ones which are newly built. So no wonder home builder stocks have done great. And Berkshire bought those stocks. Now the question was, is Berkshire late? They were late in Apple also. So anyway, I'm not chasing this because I've not done any study around the home builders. So good for Warren Buffett. Sales sold out of their ATVI, which was there anyway. It was a speculative position. Little bit sold Chevron, McKesson, GM. I don't know what is GM. Okay. Apple is the biggest one. Apple is now 51%. I won't be able to do that, but I guess when it comes to putting in new money and the old money growing to become a 51%, even though statistically, mathematically it's the same stuff, our mind tend to work differently. If I were investing in a new fund, I will never buy 51% and put it in a single stock. I don't care it is Apple or it is Jesus or whatever God you identify yourself with. I don't care. I'm not going to put 51%, and neither Warren Buffett will put. I hope so. I mean, here, because now the fund is too big, Berkshire Hathaway is too big. Warren Buffett, during these early years, have put in and taken big concentrated positions because he wanted to beat the market. Now, he's not trying to beat the market. Berkshire Hathaway, I think Warren has told, will not outperform the market because it's too big to outperform the market now. So he's not going to add 51% if we're starting a fund today. But Apple has grown to become a 51%. And I don't see, they're happy with it. I don't know. I mean, you need to have, but I guess that's why he's Warren Buffett and I am who I am. Technically, mathematically, it's the same stuff. Whether you put a new position, it is still 51% of your overall portfolio. So if you hold Berkshire Hathaway, half of it is invested in Apple. So home builder stocks have rallied. In home builder stock index is up 39%. They trimmed the positions. Apple is now more than 50% concentration risk. So if you hold Berkshire Hathaway, you need to be okay with this concentration risk. Stanley Druckenmiller, his family office, top position is NVIDIA. Again, everyone is chasing what is working. Second biggest position, and this was his top position prior to NVIDIA, is Coupang. I don't see Coupang among many of the hedge funds except Druckenmiller. So at least I have some company with him. Or as Microsoft, Eli Lilly, which hit the new all-time high recently on the drug. And what is LW? Is it low? What is LW? LW. Lamb Westmoreland. I have no idea what this is. Barry Gifford increased Mercado Libre position. Thank you. I love that. I'm in the same boat. NVIDIA, a little bit decreased by 2%, not big of a change. Again, the top position is Mercado Libre for him. Second is NVIDIA, Tesla, Moderna, Amazon, Shopify, Spotify, Trade Desk, Illumina, Netflix. Race is Ferrari. I missed that. When Ferrari came in, I think it is Ferrari. When Ferrari was listed, kind of spun out of fiat and was trying to come to public market as an individual company. There was a chatter around Ferrari. I thought maybe I look into it because of the great brand name, but I never spent time on it, and then I forgot about it. mRNA will not be back to glory days of COVID. So here's the thing. If mRNA only claimed to fame, and which I think is not correct, was a COVID vaccine, then yeah, it's gone. What we have to see in Moderna is, can the same mRNA tech be used to develop other stuff, which I think there is a potential for it. Now, what you paid for mRNA during the COVID days, that's where the valuation comes into picture, right? Will it become a Cisco that even the business will continue to grow at 10%, 20%, 30% CAGR? I don't know what it is. You may never hit those earlier valuation. Yeah, probably. Geez, I don't. Also, the revenue growth is so down. So they have to find a new pipeline, because if this was revenue was only coming from looks like the vaccine, so the revenue growth is kind of decimated. So they have to look. I don't know what's in their pipeline. So they wait for the new their miracle drug for mRNA to do anything. There we go, Michael Burry. And this is the last one. And after that, we'll be done with today. Sorry, 30 minutes over. So Michael Burry top buys, and this was so much of a chatter. in Twitter, and everyone talking about, oh, Michael Burry is 96%, whatever, 95% of his portfolio is bearish, right? And unfortunately, this is how it's being reported. So SPY put 51% of portfolio, QQQ put is 42.5% of portfolio, right? And they say Michael Burry has gone completely bearish. And those who know and have followed Michael Burry, of course, he had his credentials from the big short of 2008. But since then, he has predicted, I guess, 58 recessions, or out of 2 recessions. Anyway, you know where I'm going. So he's a kind of a perma bear, but off and on, you will see tweet from him. Now, this is why you have to be careful on if you are taking anything from social media. Most of the people, and some of those accounts I follow are respectable accounts, have no idea on how to even interpret this. And they reported like 96% of a portfolio is short. I'm like, no. That's not the case. This represents the notional value of the SPY and QQQ put. This is not the amount of money that he has invested in buying these SPY and QQQ puts. This is the notional value. Means if the market crashes and goes below whatever the strike price is the value of that strike price, not the amount of a premium that he has paid. But many folks, I guess, including some of the media people, talking about 96% of the portfolio is in, he bought SPY and QQQ puts. Are we heading for Armageddon? Don't even understand how to even interpret it. That's why you have to be careful who you follow. Sometimes you'll hear these things which are not facts. But yeah, talking about saying it 95% is short generates a lot of eyeballs, gets you a lot of likes, get you a lot of followers. Right? So that's what. It is not that it's short 95% is in SPY put and QQQ put. We don't know how much money has he spent. Probably very small amount of his portfolio he would have spent in buying these doomsday puts. I don't know what strike price it is on. But the notional value is what it is, 95%. So just to explain the concept of notional value, say if I'm on SPY, and say I go to December, let me go to next year, 21st June. Right, and I buy, let me pick 300. So I spend, let's say, for ease of calculation, $3, right? The notional value of this is 30,000. It doesn't mean I am playing, I paid $30,000. I paid only $300, but the notional value is $30,000. So what is being reported here is the notional value, because 300 multiplied by 100, each contract is 30,000. Yeah, it is 30,000. Gosh, I was just checking my math. And but I paid only $300. So I don't know what strike price he could have picked at. You could have gone further down. This is like a black swan hedge he could have put in. Right, which even if it doesn't, if let's say if the market doesn't crash, does that mean he lost 96% of portfolio? Hell no. Right. So, but most of the people on Twitter report it as such. So, which was the funny stuff. All right, let's finish it right here. We'll talk about the cloud, the state of cloud companies in our next session. Any last minute questions? Anything else you have in your mind, or what else you want to cover in next session? No, all good. Again, market down 5% doesn't matter. It's up almost 15%. Look at that. No need to make any drastic, stupid decisions based on what we hear in the social media. No one knows anything. Everyone's guess is as good as, my guess is, your guess is as good as any analyst guess. Hindsight is always 20/20, and people will try to justify. Let's say if after NVIDIA market goes down, we will see analysts coming and justifying it, why NVIDIA went down. Like today, they're justifying why NVIDIA deserve $800. I think that's the highest I've heard about analyst prediction is $800. So the range of NVIDIA is from $300 to $800 price target. So even those who are paid millions of dollars don't know what's the real value of NVIDIA is. Very wide range. Cool. All right. Thanks, everyone. Thank you for joining in. Anirudh is adding points like what to do for next week, like it's every weekend call. Add section where what all stocks to look out for the moment, either going up or down. I don't look at week-to-week basis. Unfortunately, if you need that, I don't think this is the right forum. There may be other people who look at on week basis, because again, I'll tell you, it's a 50-50 chance for stock to go up or stock to go down. So I don't build or invest based on what's going to happen in next week. So Anirudh, you may have to look for some other meetup where people talk about what's going to happen on some stocks, what might be moving up or moving down. And for long term, that really doesn't matter. So that's why I would rather spend my time on stuff that will make a difference in the long term. Okay, what to do for next week? Don't make any changes. Now, I can't tell you what you do. I'll tell you what I do is, I'm not going to make any changes. I still want to make sure my deltas are in control. So this week, a lot of those short call positions that I had on XSP, and thank you, I think it was Jay who introduced me to XSP, little more tax efficient. Now I use only that, and I'm not going to use SPY. It became profitable. QQQ, short calls on QQQ, all were profitable. So I added a little more to make sure that, my deltas don't go out of bounds. Now the stock falling, deltas have increased. So I've just reduced my delta a little bit more on Friday. But no drastic change in the way I work or manage the portfolio. Alrighty. Thank you, everyone. And we'll meet again next week. If anyone of you are interested in meeting in person, maybe hit me on a meetup. And if there are a few folks, maybe we can find some mid of the week, someday where we can meet in Starbucks or something. It was good to meet in person. All right. Thank you all. We'll talk again next week. Bye-bye.